U.S. assets have served as a safe haven, right? So whenever stress builds in the financial system, money will tend to flow into, U.S. bonds, U.S. stocks, and the U.S. dollar, right, on a relative basis. What's interesting with the current crisis is that the kind of opposites happened, right? As tensions have flared up, money is actually rotated out of the U.S. assets into non-U.S. assets. So U.S. is kind of no longer creating a safe haven. And instead, there's kind of a risk premium, a spread baked on, the yield of these assets, which is, unlike anything we've seen in recent times.
How do you best position yourself for the current tension in global trade? Today, I have with me Kai Wu, founder and CIO at Sparkline Capital. Kai, man, how are you?
Doing good. It's good to be on.
Good to see you again, man. You wrote this blog, and it was so good that that's the reason you're here today. I wanted to have you over in the channel to discuss this. The title of this blog is Investing Amid Trade Wars, so a timely topic. A lot of buzz in the market regarding this topic. And really, you talk about this because since the election, there have been tremors in the market related to potential tariffs and retaliation for those tariffs. And many investors today are asking themselves, how can I best position myself for the current tension in global trade? And today, we'll go over your answer to this question, which I think might surprise some viewers. And no, the answer is not to just sell and run away. But let me just set up the blog a little bit. To begin, the post touches on two broad types of stocks, global and domestic. From your perspective, and I think intuitively so, stocks that rely on trade, i.e. global stocks, are likely to be most disrupted during trade wars. And so you come up with this way to evaluate a stock's exposure to global trade. So I wanted to start off here. You have a 2x2 matrix framework that divides firms' exposures to global trade between producers and consumers. So here's the first question. Can you walk us through how you built this matrix and what it means for any given stock to be in any given quadrant?
Yeah, so the intuition here is that there are two vectors over which companies can be exposed to disruptions in global trade. The first is on the customer or revenue side. So imagine you're a company, say, based in the US, and you are selling to Chinese consumers, and then China puts a tariff on your goods that makes access to that market much more difficult. And then the other dimension is on the production or supply chain side. So let's take the converse situation where imagine you're importing goods from China, and the US puts a tariff on Chinese imports. Well, now suddenly your goods are a lot more expensive, and that's going to put a wrench in your plans here. So there's a production, and then the sales or consumer side, and then along each of these dimensions, I arbitrarily chose a cutoff point of 25%. And so what I mean by that is, take the customer side. If 25% of your sales are to non-US, in this example, customers, we consider you a global firm. Otherwise, a domestic firm. And on the production side, the same thing. If 25% or more of your production occurs abroad, then you are a global as opposed to a domestic company with respect to this dimension of production. And now, as you point out, you can actually create a 2x2 matrix where on each axis you have one of these two dimensions, and that gives you four quadrants. So each company can now be classified into one of four different groupings. So on the diagonals, let's take on one extreme companies that are purely domestic. United Health, this was the example that we gave in the paper. They both, their customers are all based in the US or mostly based in the US, and the goods, in this case services, are produced also in the US. On the opposite extreme, you have what I call multinationals, which is a loose way of a terminology here, but those are basically companies that both produce and sell globally. On the off diagonals, you have importers and exporters. Exporters are companies that produce in a given country and then sell across the world. Some examples might be European luxury good companies or automakers. And then in the other side, on the import side, Restoration Hardware, of course, the famous example. They mainly import goods, say, from Vietnam and other places in Asia, and sell to the U.S. consumer. Right. So those are kind of the four categories that any company, whether based in the U.S. or abroad, can be placed.
What are the effects of each quadrant. So if a stock is in a specific quadrant, how would you suggest that tariffs affect each of these?
Yeah, I mean, like, so the way I would think about it is these things kind of compound. So if you have a company that is, let's say, just selling to US customers, but has production abroad, that's obviously a vulnerability, which may or may not come into play. I mean, it depends a little bit on the exact configurations of tariffs. At least as of Wednesday, May 14th, if your production is based in China, that's a lot worse than your production being based in, say, the UK. But that's obviously subject to change. And then conversely, the idea of exporting, say, from the U.S. to other countries will depend a lot on the reciprocal tariffs that other countries are now placing on the U.S. And again, this is all subject to change. But the broad idea is that the more global a firm is in its footprint, with regards to customers or with regards to its supply chain, the more generally exposed it is. And I think later in the paper, I do spend some time kind of fine-tuning the framework in a more granular way to look at exposure to specific countries or regions, which may be more in the crosshairs, in terms of the geopolitical tensions today.
So here's a question you asked, and I think this question gets at the crux of everything. And I'm going to quote you here: "If we expect a trade war, why own global firms at all?" Of course, global firms, like you mentioned, tariffs are going to affect them the most. Why? What's your answer to that question of why even own global firms at all?
Yeah, I mean, this is a pretty fair question, right? Which is like, I think we did see a lot of investors on the day after Liberation Day dump their global stocks. Right? As I mentioned, Restoration Hardware went down 40% in a single day. But the question I wanted to ask was, if you kind of step back and take a longer term view and study the historical data as well as the characteristics of companies that are qualified as global firms, is there a meaningful difference? And the answer is yes. I think a few findings stood out to me. First, we found that global firms are significantly higher quality businesses. And that means, for example, return on equities of 30% as opposed to 15%, so twice as profitable names. They tend to be exposed to more innovative concepts. They invest more in intangible assets. That's not just intellectual property and patents, but also brand equity, human capital, and even network effects. And have obviously experienced also higher growth rates. If you kind of ask the question of how does that translate into stock returns, you'd also be positively surprised, pleased to find that these multinational or global companies have also enjoyed much better stock performance than their domestic peers. In fact, if you were to decompose the returns of the either the global or even just the U.S. stock index, you'd find that the vast majority of returns were generated by the global subset of stocks, with the domestic subset kind of being closer to deadweight on the back of the bull market.
So in Exhibit 7, you were mentioning this. You showed the historical returns of domestic versus global firms. I think it's pretty clear global firms have trounced domestic stocks. Now, you adjust, and you mentioned this in the paper, you adjust for differences in sector and country. And as I was reading it, I was just thinking about, what about other risk and factors? Right. So many factors have also not done so well post GFC. And I'm interested to know if you happen to touch on that research too. Do domestic stocks correlate with other traditional risk factors?
Yeah. So if you kind of use like a bar style model, there's different dimensions of risk that could potentially explain some of this phenomenon. I guess you already mentioned the most basic, the idea of industries. It does turn out to be the case, by the way, that these global firms tend to be in industries that might align more with, say, technology. In fact, hardware, software, semiconductors are amongst the most global and also best performing sectors. That being said, you also find a high concentration of global firms in sectors such as materials, which have done less well over this period. And so it's not a perfect correlation, but that it does explain some of the excess returns. One thing I did in the paper was control for the industry and sector composition and find that, despite that control, you still find that in a given sector, the global firms outperform their domestic peers. Examples might be like Netflix is more global than Disney and has done better over this period. We can also look at size as an important factor. So like if you look at the top 10 stocks in the world, with the exception of Berkshire Hathaway, they're all multinationals, right? Apple, Nvidia, Microsoft, Google, Meta, Tesla. And so there could be something there. What we did do is we looked at the extent to which, if we look at, say, an equal weighted index, which gives much less weight to the mega cap names, you get the same results, and we did find similar results. The third thing we looked at was country exposure. Right? Maybe it's the case that for whatever reason, U.S. companies are more multinational than European and Japanese companies, and if that were the case, because the U.S. stock market, as we know, has done well the past 2 decades, that could explain the discrepancy. It turns out to be the case that that's not true. That even within, say, Europe or within Japan or within the emerging markets, it's been the global companies that have outperformed their domestic peers, whether it's Novo Nordisk or Samsung. And then the final thing we did look at, although I don't think we touched on it as much in this paper, is what you're bringing up here on traditional factors. So I mentioned size as well as profitability. So these global firms tend to be more profitable, and therefore they tend to load more on the quality or profitability factor. In addition, they tend to trade at a slight premium, and we can get into a little bit more how we would adjust for this. But at least at face value, the market knows that these companies are higher quality, and therefore it should trade at a, say, price to book or price to earnings premium, which they do, or at least slightly. And so you want to theoretically adjust for those factors too. And if you do, you still end up with the same phenomenon, which is, even adjusted for the various factors, industries, countries, and size, global firms outperform their characteristic matched peers.
Yeah, I'm glad you mentioned that. I was going to ask about valuations. It does seem that a lot of the multinationals tend to be more growthy, a little bit more expensive. But that's, again, like you mentioned, only if you look at it from a valuation perspective. I think taking into account quality is super important in this research. Now, I wanted to touch on global stocks. My question to you is, are stocks that are global today maybe stocks that just increased revenues and then expanded their market as just a natural way to gain market share? They just started generating global revenues in the past. So in other words, is there a potential danger for survivorship bias when evaluating today's global stocks?
So let me maybe describe a little bit how we constructed this study and this backtest. And so the idea was to try to utilize point in time data to the extent possible. So let's imagine we're sitting here in 2010. What we do is we look at data only up until that point in time. So all the 10Ks up until 2010, all the information as to where employees might reside, other textual documents, all the different disclosures and information up to that point. We then form a basket of stocks that, based on that 2x2 matrix, are considered global, and then the opposite on the domestic side. And then what we do is we roll forward in time, look at the returns, and then rebalance at the next period in time, now using data 1 month or whatever further in time. So that gives us kind of a sliding window in terms of what we can look at to construct the basket. So there's no look ahead bias, at least from a methodological standpoint. It ends up being the case that companies that were more global, say in 2010, then went on to outperform their peers that were less global. I think there is one element, and I talk about this a little bit in the paper, of a selection bias effect, where the causality is a little unclear where the causality lies. Right? On one hand, you could argue that maybe it's the case that these companies have access to operational efficiencies, that they can outsource into cheaper markets or access to talent pools that are very specialized, such as semiconductor production in Taiwan. That you wouldn't be able to access if you could only utilize, say, a U.S. talent pool. That could be the case. But it could also be the case that there's a selection bias in as much as if you are a company that ex ante knows that they are a better company, you are going to want to compete in a global arena because you're going to compete over a larger total addressable market with higher spoils. And yes, the competition will be fiercer. Now you have to compete against, say, European, Japanese, and Chinese firms. But if you are actually as good as you think you are, then that should be no problem. Whereas if you kind of are a second-rate firm, then you're probably better off just competing in your local market and staying away from the global competition, even if that means your overall upside is a little bit smaller. And so which way does the causality go? It's not really clear. I mean, there's nothing that I did in my analysis would attempt to address the causality. It's probably, as with almost all empirical exercises a combination of both.
Yeah, it's super interesting. And I think we're going to touch on that later on regarding domestic stocks. It seems to me, just intuitively by thinking about it, that if you're a domestic firm, I think ideally, based on this evidence that you've presented, you end up hopefully transitioning to being a global firm. It seems to me like a next natural step. And then just wondering, like, hey, why doesn't every firm think that way? But I think you touched on that. Let me go to this question. You present the idea of geopolitical risk premium. So this is a way you explain why global firms have outperformed domestic firms. So can you guide us through that? How did you come about this conclusion?
Yeah. So this goes back to what you were saying earlier, Jose, about valuations, which is in an efficient market, everything should be priced in. So we know that these companies are higher quality, so therefore they should trade at a premium. And if the market were efficient, the premium would be exactly enough such that it would offset the advantage they have in terms of higher profitability and growth. Obviously, that has not been the case. And if you look historically, these global firms have done way better than the market and their domestic peers. And so the market is effectively selling these guys at a discount to their quality-adjusted fair value. And why would that be the case? Right now, there's always the explanation that it could potentially just be an arbitrage, that the market is not smart enough to know and they made a mistake. That's possible. But if you kind of think about what could be the explanation, which is what I tried to do in this case, one plausible argument that came to mind was this idea of geopolitical risk premium. So here's a hypothesis. Maybe it's the case that investors know that companies like Apple face additional risks that their domestic counterparts don't face because they have, say, reliance on suppliers in China via Foxconn. And if that is the case, then maybe they should sell at a slight discount. In other words, embed a expected return in the form of a geopolitical risk premium. Seems like a reasonable argument to be made. How do you actually test that? Well, that's hard. One thing we did do in the paper was we used this index called the Trade Policy Uncertainty Index, which was created by a handful of Federal Reserve economists. And basically, it's a time series data that spikes whenever news around trade uncertainties increases. So obviously, it spiked a lot around the first Trump trade war, and it's at all-time highs today, post-Liberation Day. So what we can do is we can say, at least ex post, what is the relationship between the returns of global versus domestic stocks as opposed to changes in this trade policy uncertainty index? And what we find is when the index spikes, the global stocks have underperformed or have historically underperformed their domestic peers. We saw that on the day after Liberation Day. I mentioned Restoration Hardware down 40%. That appears to be the case. So look, I mean, this is one way of potentially validating the argument, but a couple pitfalls here. The main one just being that these spikes in the index are extremely rare. I think it's only 60 basis points of the sample. It falls into this extreme right tail. And so whenever you have a rare event, and this is not specific to this analysis, but in any kind of empirical data, when you have a very unbalanced panel, trying to infer too much from a very, very small subset is always a little bit challenging. And so we consider it relatively weak evidence, but at least evidence nonetheless in support of this argument that at least maybe some of the returns here are just compensation for geopolitical risk.
Yeah, so I would say that's probably more of an efficient market's view on why global stocks seem to be outperforming domestic stocks. So let me go through what we've talked about so far. I think we've concluded two things. So the first one is that global stocks have historically outperformed due to higher risk exposures to geopolitical risk. We just talked about that. And then the second thing we can conclude is that amidst trade wars, one can predict that global stocks will suffer the most. So showing viewers here, Exhibit 17, you can see that global firms had already begun underperforming domestic stocks since the presidential inauguration. You made a point of saying that it wasn't just after April 2nd, although obviously once April 2nd Liberation Day happened, you can see a huge spike downwards, and that difference really becomes clear. So we conclude that, but then your response to this, which I think would have at least to this point paid off handsomely since April 2nd, is to say, stay the course, right? And I'm going to quote here, not view domestic stocks as a good long-term structural allocation. My question is, why is that? Should investors just avoid domestic stocks altogether and just focus on multinationals?
Okay, so I think there's two things here. So first is, if you were one of the investors who said, I see trade wars coming, I'm just going to, sell all my global stocks and hide in domestic stocks. And let's say, imagine you did this at some point over the past few weeks. What you were basically doing is making a bet on the trade war escalating. If the trade war continues to escalate, then you make money on a relative basis. And if it, abates, as it actually ended up doing, or so far, we'll see, then you actually lose money. So it's a one-way, it's a double-edged sword here, where you're making a kind of directional bet on macro policy. And I think that's really hard to do. Obviously, if you made that call, you would have been wrong. Over the past couple of weeks, it doesn't mean you won't be wrong. You might be rewarded over the next couple of weeks, but it's a very challenging thing to market time and to predict macro policy. And so I generally try to stay away from that, but instead to think more long term about, if you were to make a structural allocation to a subset of stocks, how would you think about that? And I think, we've already established in the first part of this talk that, first, that the global firms are more profitable, they're more innovative, they just are higher quality businesses. So, underweighting that bit, would only make sense if they were trading at a huge premium. So domestic stocks, at any price, a stock can make sense, right? Maybe it's a less good stock, but at some, bargain fire sale price, it makes sense to own. And so if domestic stocks were trading at a huge discount to global stocks, maybe that would be a decent entry point. The problem is, at least when this paper was written, it was the opposite, because global stocks had just sold off, right? And generally, if you want to sell insurance, you want to do it after the hurricane. And so that doesn't make, at least from a timing standpoint, from a tactical standpoint, that wouldn't be the argument here. And again, that's not to say that at some point in time, over the next several decades, there won't emerge a period over which domestic stocks will be the better play based on a valuation basis. But I think it's pretty irrefutable within the data that it's the global firms that are higher quality, more profitable, more innovative, faster growing, and are in a neutral equilibrium state, the stocks you want to be in.
Yeah, I think the general application there would be just stay the course, no matter what your allocation is. Thinking through what to sell and what not to sell after a huge crash, I think it's always a little bit dangerous. It just goes to show, like, even trend following, which in and by itself, it has rules, but just goes to show, like, we're in a huge whipsaw for trend, right? And that's what it does. I think it's okay to have an allocation to trend because you expect those things to happen and you understand the risk. But I think people who were not trend followers, who ended up selling, not because of trend, just because of intuition, you can see how they might have gotten hurt. And now the question is, like, when do you get back in? So all to say, I really appreciate the research. Let's go over 4 things you recommend investors consider. So maybe we can quick fire through these, but these are 4 specific recommendations that you suggest investors listen to. So maybe go through them, explain to me the why behind them. Here's the first one: low China reliance. So I'm going to quote you here. Corporate leaders began to recognize China as a single point of failure and started diversifying towards a China plus one supply chain strategy. That is from the blog. You can see that this is not a new risk, right? This is a risk that I think people have known about for quite a while, but specific to tariffs, specific to the trade wars we're in, and why low China reliance.
Earlier, I created a global risk factor that said the more global you are, the more exposed you are, but without differentiating amongst where you're getting that exposure from. Is it from Canada or is it from China? Because in practice, those are very different things. Clearly, if you look at Trump's rhetoric and his policies, and by the way, Biden's as well, right? This is a bipartisan issue. Concern around Chinese hegemony is definitely a strategic issue for the U.S. And so, therefore, any supply chain that winds through China should, in theory, be more exposed to disruption than elsewhere. And companies have, up until recently, been okay to taking that risk because of the many advantages that China brings, especially like rock bottom cost when it comes to manufacturing, as well as relatively business friendly practices and human capital and know-how that supports especially the electronics industry, which is heavily exposed to China. What's interesting is, as you point out, this has actually been unwinding over the past 15 years. So since 2009, corporate executives in non-U.S. non-Chinese firms have actually been starting to reduce their dependence on Chinese suppliers and personnel located in the mainland. So that's actually been really interesting to see that, Trump obviously is loudly beating the drum here, but he's not the first person to recognize that at least, in America and the rest of the developed world, there's kind of an unhealthy dependence on the Chinese, being the workhorse factory of the world. So anyways, the idea was, let's now refine our metric of global production exposure to specifically isolate companies that have exposure to China as opposed to the rest of, the non-domestic production base. And what you find is that the results line up with intuition. That, as I mentioned, a lot of electronics and semiconductors. You also see exposure in automobiles, apparel, things like that. And what's interesting is, the natural next steps is to say, well, if that exposure seems so dangerous, why don't we just exclude it? Okay, so we can do that. Let's get rid of the companies that have high exposure to China. You would expect that to actually reduce your returns because you're now reducing your opportunity set. What's really interesting in the results I found was that at least over the past 15, 20 years, it would have been the case that the returns would have been basically the same. In other words, hedging your risk to China was kind of a free option, so to speak. And now, again, this could be very sample specific because China, over this period faced, many challenges internally, and we have seen a general pullback away from China into countries like Vietnam, India, and Mexico. So there could be some sample specific issues here, but at least from a high level, it seems like this is not a crazy idea if your goal is to maintain exposure to globalization while mitigating some of the particular risks around the China-U.S. relation.
I wanted to take it a step further. I think we would almost all agree that China represents a huge left tail risk, right? Just to give a quick example, some hypothetical of China invading Taiwan, right? That could, similar to what the Russia-Ukraine situation in 2022, similar to the effects that had, I think, with China probably more pronounced. And yet, so for example, you could say, hey, instead of manufacturing in China, why don't you move that manufacturing to Taiwan? There's probably a risk there as well, right? So how do you view the potential tail risk of China affecting the rest of the world?
Yeah, so I mean, that's a good point you're making here, which is you can, in terms of first order exposure, I think we would start off by saying any company that has production or suppliers based in mainland China is at risk. And then the second order thing would be to say, well, actually, it's the entire kind of Asian region, Taiwan being obviously one option, but as well as like Vietnam and a lot of the countries there that are kind of indirectly impacted by trade. A lot of the intermediate goods, by the way, flow through the mainland through Vietnam, Hong Kong, etc. So the whole region could potentially be at risk. One thing you could do, and I actually did look at this, is to define a kind of broader regional boundary of what you consider like kind of the hot spots to avoid. The results, again, over the past 15 years look about the same. Again, we haven't seen an invasion of Taiwan. If we did see that, I mean, you'd expect the index to actually outperform, right? The China exposed, non-Taiwan exposed stocks would probably on a relative basis do well. Of course, it would be a catastrophe across the board, for basically the entire economy, right? I mean, we wouldn't really have, the wonderful iPhones we have now. We'd be set back a few generations. So that would obviously be catastrophic, for the world. But that being said, like, on a relative basis, I think that would probably be the case. So we're only talking in terms of expectations here, not in terms of what actually happened, because we don't have that in the sample.
Yep, agree. That would probably be one of the worst circumstances we could see. But I think that's also important. Like, hey, maybe it's not just for stocks to have low China reliance. I think it's almost like a security concern for the world to take that into account. Let's move on to the next one. And I want to start off this one by showing Exhibit 31. You show that global firms with resilient supply chains have not only outperformed domestic firms, but they have actually outperformed global firms. So guide me through this one. What are resilient supply chains? What is this factor you're talking about here, and why target them?
So there's a two-stage thing here. The first thing I looked at was supply chain concentration. A company whose all their suppliers, they could have millions of suppliers, but they're all located in the same country, say China, that's a huge issue if China is the one that gets tariffed. And so one way of measuring that is you can look at all the different suppliers of a given company and figure out, how diversified they are at the country level. And we use a metric called the Herfindahl-Hirschman index to measure that. It's a commonly used metric of like market concentration. So the more concentrated you are, the more exposed you are, the less, the better. So that's the first thing we look at. But that's not obviously sufficient in the event that, say, on April 2nd, when Trump put tariffs across the board, it doesn't matter where you are, you're kind of in trouble. So that's where the second piece comes in, which is, what I call like an alignment indicator. And what that is this, which is, imagine you are an auto company and you produce cars in the US and you export globally. Well, that's all well and good until China says, we're going to tariff US manufactured autos, and Europe says the same thing. So now what do? We say, well, maybe what I'll do is I'll build a factory in China to produce cars to sell to Chinese people, and produce a car and build a factory in Europe to sell cars to European people. That's a strategy called localization. That's exactly what Tesla did, in the first Trump trade war. And that helps you get around some of these tariff issues. So we can measure this actually by just looking at the geographical distribution of sales compared to production. And to the extent that they look the same, that's alignment. And if they look different, that's misalignment. And the more aligned you are, in theory, the more resilient your supply chain might be. So we combine these two metrics together for each company to give them a kind of resiliency score, from high to low. And then what you described in this study here is we said, in the same way we did it with the Chinese risk factor, we said, let's look at the global stocks, but now let's focus on the subset that have greater supply chain resilience, that's defined this way. And what you actually found was, and again, in expectation, this should cost you something, right? Because you're now reducing your opportunity set, giving up potentially good investment opportunities. But in practice, it basically costs you nothing. In fact, you actually would have done slightly better historically to be kind of in these more resilient supply chain companies. So, you could argue that this was like a negative cost insurance when said this way. And again, I think this is probably sample dependent. Like, I wouldn't necessarily infer too much into any of this. And everything here is a back test. So you want to take everything with a grain of salt. But, at least this gives you an idea of, if you were to be thinking about how to, justify continuing to be exposed to global trade, even amid a flaring trade war, by tilting towards companies with more resilient supply chains, with less China exposure. I think it gives you some cover and some more comfort and more confidence in being able to maintain that exposure, even in spite of some of these pretty scary news headlines.
Yeah, maybe we should send this paper to every CEO in America, see if they can get some ideas of how to handle their supply chains. All right, third one here, significant intangible assets. Now, you are an expert in this area. A lot of your research focuses on this idea of intangibles. The question here is, why focus on intangibles during trade wars?
Yeah, so I think the first thing is, it's just empirically been the case that global firms have tended to be more intangible intensive, and vice versa. There's a kind of a correlation between these two ideas. And the reason why is, if you think about what intangible assets are. So first of all, intangible assets are, we have kind of four categories for intangible assets: intellectual property, brand equity, human capital, and network effects. Those are examples of intangible assets. One of the key properties of intangibles is that they have this scalability. And what I mean by scalability is that it often requires a lot of money upfront to develop, say, IP or brand. And then once you have that asset, to the marginal cost of producing incremental units is close to zero. So for example, you can spend $1 billion creating a new large language model, but then actually serving it is relatively cheaper on a kind of per unit basis. So the incentive, of course, for a company that was going to invest $1 billion up front would be to spread that cost over the broadest possible customer market, i.e. a global market. And so for that reason and others, we tend to find it to be the case that companies that are in the global arena are also more intangible intensive businesses. But the other thing is that, if you think about what insulates companies moving forward, right? So what are trade wars? Trade wars and what are tariffs? Tariffs are basically barriers placed on physical transport of goods. Say if you put a good on a ship from China, send it to America, you go to customs, they're going to tariff you right there. Now, intangible assets can't really be tariffed. There are ways of impeding their usage, like through taxes or kind of IP laws or other kind of legal requirements. But for the most part, these assets of intangibles are not able to be tariffed, and they are not able to be kept in any one location. Right. One of the things that researchers find is that amid geopolitical shocks, physical assets, investment in physical assets tends to be curtailed. So if I'm a CEO and I'm thinking about maybe building a factory in Mexico, but I'm not sure if that country is going to be tariffed or not, I'm going to hold back and kind of wait and see what's going on. Whereas what researchers find is that intangible investment continues to continue apace even in the face of geopolitical risk, because it doesn't really matter. You're creating the asset. It has it cannot be confined by borders. It'll kind of go anywhere. So, at least from the standpoint of how companies are, say, positioned today, global companies are positioned today relative to 100 years ago when they were much more physical and less intangible in nature, that should definitely be a pro with regards to how we might expect these companies to navigate, the environment moving forward. The other thing I look at is I kind of say, what if we were to subset the global versus domestic universe with regards to higher versus lower intangibles? One thing I found is, in general, right, that intangible companies tend to outperform less intangible companies. And it's interesting to be the case that even within the global universe, the more intangible global companies tend to outperform the less intangible global companies. And then within the domestic universe, the more intangible domestic companies tend to outperform the less domestic intangible companies. So these effects kind of stack on top of each other in an interesting way. Right? Earlier on, you asked me the question around factor exposure. Right? Is it the case that global firms outperform even controlling for XYZ? What we find here is effectively the answer is being yes, that global firms tend to outperform even within the intangible universe and vice versa. And so the idea here is invest in global firms because globalization has been good and these companies do better. But if you then additionally tilt to the subset of global firms that are higher intangible intensity, these companies will be more resilient, in theory at least, to tariffs and other trade barriers, while also potentially having higher excess returns based on some of the research we've done around how intangible assets tend to be undervalued, yet they drive a good share of earnings growth in the economy.
Yeah. Let me ask you this question. The U.S. has been on a tear up until the beginning of this year anyway. For the past 15 years, the U.S. trounced basically every other foreign market. My question to you is, does that have to do with intangible investment? I think you did talk about this in the paper. And what can other countries do, if that's the case, to incentivize that investment in intangible assets?
Yeah, so this was actually this research was from a different paper I wrote on it called International Intangible Value. And it was really interesting because I started off by showing that the returns of U.S. stocks have been much higher than non-U.S. stocks. And then I decomposed that to say, is it just a multiple issue that the valuations of U.S. stocks have increased more? And the answer is that that's part of the reason, but the bigger driver was actually the fact that U.S. companies have just had higher earnings per share growth than non-U.S. companies. So if that's the main culprit, and at least the way I view it, that the margin expansion, there's a multiple expansion piece was secondary, that it that was just adjusters looking at the past data and saying, well, U.S. companies are better, so I'm just going to pay more for them, which obviously, if that continues moving forward, is the correct thing to do. So if the game's all about earnings per share growth, I said, well, now let's look at the country basis, and we can say, I created a scatter plot where on the x-axis you had the starting level of intangible investment. So this was in 2010. And then over in the y-axis, I showed what is the earnings per share growth of each of these countries over the next, say, 15 years or so. And there was a really high correlation between these two variables. I want to say it was like somewhere between 50 or 80 to 80%, depending on how you weight the market caps of these two countries. And so I was able to argue. So I made the argument that, look, the world is very complicated, and there's oftentimes, multiple factors driving things. So it's kind of shocking and in a way impressive that a single variable, which is how much investment has a country made in intangible assets? And that includes not just research and development, which is of course the most well-known one, but also branding and human capital, employee training, aspects like that. That seems to be the single most important driver, as far as I can tell, in the future prospects, kind of the wealth of nations moving forward. And the argument, of course, being that the reason why non-U.S. companies have underperformed U.S. companies has been because they've underinvested historically in these assets. Now, will that continue moving forward? Unfortunately, it seems to be the case that there still is this gap on average. Again, that's not always the case for any individual company or any individual country, but that continues to be the case. Of course, valuations are much higher in the U.S. by some measures, 50% higher or 100% higher, I guess, than in non-U.S. countries. So that might be already adjusting for that gap. So maybe people already know this. But to your question, I mean, that's really like, if I were a development economist, this would be kind of the main question I would be asking, which is, how can I encourage more entrepreneurship, more human capital formation? How can I encourage more research and development, reverse the brain drain, and incentivize private enterprise to engage in modern management and branding practices? These would be the things that I would be thinking about. But again, like it's so case by case. It would obviously be differ for each country.
Yeah, I think it's so interesting because there's factors like that are pretty hard to quantify. I'm sure you're great at doing that anyway, quantifying the qualitative, but things like culture, right, that shape so much of what the U.S. has done. So on a more human level, just asking you, what do you think are some of the factors that have allowed the U.S. to invest in intangibles versus international not having done so, at least in the past 15 years? Is it culture? Is it things like regulatory policy? What's so special about the U.S. that has allowed that to happen?
Well, I think culture is definitely an aspect. I mean, I studied company level culture using Glassdoor reviews, and it is at least the case within the kind of cross section of companies that firms that have more innovative cultures have tended to outperform. But I would also probably make the argument, even though that's not in this data itself, that the kind of more innovative and entrepreneurial attitude, more risk-taking attitude of America would probably also show up, at a more macro level. I think there's an aspect, as I mentioned, of these scale economies, right, where there's kind of increasing returns of scale associated with intangibles. That the big kind of get bigger, right, and that's and so you can end up with this flywheel effect where, to take an example, like a lot of the initial AI innovations, innovated in Silicon Valley, and once that kind of started, there was a flywheel where more talent kind of came there, and the best engineers started to glom onto that trend, and that industry has now emerged, and with the exception of maybe France and China, the largest and most dominant researchers and companies are in the U.S. I'd say the university story is another part of it. I think obviously the elite universities in the U.S. are much maligned now. I think excessively so, to be honest. But if you go back over the past 50 to 70 years, that's been a big part of the story, where some of the most talented and brightest minds in the world have gone on to study in the U.S. And have then contributed their talents to the U.S. stock market and business economy, which has been obviously helpful too. So there's a bit of a kind of a network effect, scale economy component, in addition to the regulatory kind of risk seeking entrepreneurial culture aspect of America that makes it somewhat unique relative to its peers. And again, it's not the only country that has many of these dimensions of like economic freedom and such, but it is probably the one with the most salient advantages.
Yeah. That scalability really does show. Like, for example, I live in an emerging market, right? Live in Colombia as of now. And it is something you do see here, where a lot of the talent, right, the top performers here end up going to the States. And so that's every person that moves out of the country to contribute to the economy of the States, as a country, is a person that we don't have here to develop this country. And so you really do see the scales shift, at least in that specific example. Now, we've talked about the U.S., and I don't want viewers to think we're, 100%, let's just invest in the U.S., forget about everything else, because that actually goes on to the next point. And I want to quote this from your paper here: rather than a safe haven, the U.S. is now trading more like an emerging market facing elevated country-specific risk. And your conclusion here might actually sound a little counter to what we just talked about, but a recommendation you make here, and this is the last one, is to target non-U.S. domiciles. So explain the disparity here.
So first of all, no offense. Just making the observation that historically, right, the U.S. assets have served as a safe haven, right? So whenever stress builds in the financial system, money will tend to flow into U.S. bonds, U.S. stocks, and the U.S. dollar, right, on a relative basis. What's interesting with the current crisis is that the kind of opposites happened, right? As tensions have flared up, money is actually rotated out of the U.S. assets into non-U.S. assets. So U.S. is kind of no longer creating a safe haven, and instead, there's kind of a risk premium, a spread baked on the yield of these assets, which is unlike anything we've seen in recent times. And I think what that points to is this idea that a lot of the geopolitical risk is now U.S. specific. Right. Historically, it would generally be the case that, okay, if something's going down, it's probably something to do with China, and we want to get out of China, let's go back to the U.S. We're safe here. In this case, it's the exact opposite. Where it's the U.S. that is initiating a trade war and potentially wants to withdraw itself from the global system. And so, what's really interesting is over the past 20 years, as we discussed, U.S. stocks have been the big winners, and investors, for the most part, remain, especially U.S. investors, remain overweight U.S. stocks. And for the first time in a while, we're now starting to see kind of a sustained period of underperformance in the U.S. relative to global stocks. I think the global stocks are up 12% this year, and the U.S. is flat. And so these non-U.S. stocks have now demonstrated resilience in the face of this crisis. So investors who recognize that obviously non-U.S. stocks are cheap and have been cheap for a long time, that there might now be a catalyst to get involved. Now, what are the problems? Well, there are kind of two objections I mentioned in this paper around why one would not want to go into global stocks or non-U.S. stocks. The first one is that non-U.S. companies are less dynamic than U.S. companies. I mentioned this argument around intangible investment being kind of the key driver here, which is, said differently, that non-U.S. stocks are less intangible intensive and investing less in, say, R&D and innovation than their U.S. counterparts, which is true on average. But what's interesting is if you just look at the top subset of non-U.S. stocks that are the most global, the most multinational, as I mentioned kind of in point 3, that these stocks actually are pretty highly intangible. And the other second argument, which ties into this, is that growth in the non-U.S. economies, say think Germany or Japan, will tend to be pretty low, or people expect it to be pretty low, and therefore that's a problem for companies that are tied to the domestic markets. Again, if you invest not in, say, Spanish banks or real estate companies, but instead invest in multinationals in Europe, Japan, and Asia, you're actually getting companies that have as much exposure to the U.S. as many U.S. companies do. Right. So the examples I gave in the paper are think about Airbus versus Boeing. They're basically doing the same thing. They just happen to trade in different countries, or like Samsung or Novo Nordisk, LVMH. These are all global brands that drive the majority of their revenue outside of their home countries, and are in many cases as good, if not better, than their U.S. counterparts. And here's the kicker, which is that these companies trade at a 50% discount to their U.S. peers. So you adjust for all these factors. It's like, hey, here's a global company that happens to be domiciled in Denmark, and here's one that's in the U.S. And on average, you find a huge discount, which I think is pretty interesting. So you kind of put all these things together, and you're saying, all right, well, there's a big discount for international companies, and if we're and we can get around a lot of the issues with the slower growth and such by focusing on the global subset of non-U.S. stocks. They're cheaper, and they don't face the same geopolitical risk that appears to be specifically in the U.S. now, and so you end up with this diversification benefit in addition to the valuation discount, while having firms that are with some exceptions kind of similar quality. And so that's kind of the fourth suggestion, which is to tilt your global firm portfolio outside the U.S., or at least don't be so U.S. centric as you may have been in the past.
I would agree with you. I think this year has been one of the best examples of why you invest internationally. And the other thing to mention is there may be slower growth priced into these international stocks. At the same time, like you mentioned, valuations are cheaper. So I think you are being fairly compensated for taking on that risk, making it almost an equivalent trade to investing in the U.S. At least that's what an efficient market would do, or at least a highly competitive market where at the very least, players are trying to price these things in as closely to perfection as they can. But that concludes it for today. I want to thank you, Kai, for coming over, having this discussion. Interesting paper. I'm going to encourage viewers to read the blog, and I'm going to link it in the description. For you, Kai, any last parting words, and where can viewers find you?
Well, thanks a lot for tuning in. You can find me. Just go to my company's website, sparklinecapital.com. I have this paper posted there, as well as a lot of other research pieces I've done over the years. You can also just reach out to me directly, by email or on social media. I look forward to hearing from you.
Any fun research pieces you're working on? Maybe not research pieces. Anything fun going on in your life right now?
Nothing fun's going on in my life. just work.
Well, same here, brother. All right. Well, thanks for coming over, and viewers, we'll see you next time.